Hi guys, welcome back, and I hope that you guys were okay. For the past 2 weeks, we have not at live because we were on a summer break. Okay. Now we are back, and hopefully in a good time to actually catch the market. And hi, my name is Ming Hon, and I'm the host for Traders Talk. And welcome back to Traders Talk. And we have been hosting this show for the past. Over a year right now, and of course there are many things we have actually covered, and we continue to cover because market is very dynamic, and things change every now and then, and we hope that we can actually go through the market together with you guys, and also try to actually help you guys to actually trade better, and also to actually learn and pick up trading if you guys are new to the markets. And basically the show focuses more on trading the US markets, and we do specialize in trading of options. Yeah, so for those guys who are keen to actually take up options, this is actually a great trading tool, which complements also with your investments, and also trading the stock market. Yep. Of course, if people are just solely investing in stocks, options is also a good way to complement the earnings, the income that you actually generate through stocks. Because, of course, if you buy a stock for long-term investments, uh, most of the time we are actually waiting for the value to appreciate. Yeah, but of course, markets can actually go up and down, and during bear markets like this, you can only see your portfolio value go down. Yeah. So of course, today we are actually going to do a money heist on the market. Okay, what is this money heist? And if you guys see this show, right? This is actually a group of people who rob the bank, rob the bank, right? And I have not really seen this show in full, but I have seen a few of the chapters. Basically, is a group of people who actually go into the bank and rob the bank. Yeah, so we are not asking you to rob any banks, but basically to actually give you a method to actually talk about more today, a method where you guys can actually benefit from using options to complement your current investment portfolio. Yeah, investment portfolio. And if you're investing or buying shares, we're going to actually share with you a method by just adding this options instrument, how you can continue to actually generate income even during a bear market, and also at the same time to protect um, the value of your investment in case the share price actually come down. Yep. And of course, besides that, we will cover that mostly in the second session of the show. And the first session, we always actually go through the market, the last week market, how the market has actually performed, and also give our views, our personal view on the current market, and what basically we expect to see in the current week, and basically what kind of events are also going to happen in this week that will actually affect the market and cause some kind of volatility in case that kind of news or events would actually move the market. Yeah. Let's just go straight on to the charts first. Yeah. So thanks for those guys who have actually just joined us, and I believe some some people have been asking me where have I actually gone in the last week, because they don't see me. They've been seeing me for the past year every week, right? And suddenly, if I don't show up on Tuesday evening, they are scared that I got kidnapped or something. Okay, so let's just share the screen on the markets. Okay, let's choose this. Okay, yep. Yeah, this is the Euro USD. I mean, if you guys follow the forex market or the currencies, right? If you can actually see, the euro has actually gone to parity towards the US dollar. Yeah, towards the US dollar. Although I think yesterday itself, yesterday or last week, the they actually increase interest rate in the in interest rate, right, for the which country, I think it's Germany, right? They increased interest rate in some of the countries in Europe, but basically the effects is not there. So the currency continue to actually go down. Yeah, so Europe seems to be in a big problem right now, and of course, for those people who trade forex, is also an opportunity. Yeah, in this area. Yeah. So let's go to the US market. Let's go back. Don't divert. Let's go back to the US market right now. Right. This is actually the S&P 500. Yeah. This is basically the key index which we actually see and track the market. Yeah. Basically, we look at mainly two index. The S&P is one. Yeah. The S&P is one. And of course, Nasdaq is another one. Just a second. Let me just go through this. Okay, Nasdaq is another one. Okay, so if you look at the S&P, I think where we stopped. I mean, where we before we left off the traders talk, right? Which was basically 12th of July was the no 5th. We took a break last week on the 19th and 12th. I think the last one which we had was actually on the 5th. So where were we when we left off the market? The market was actually slowly running up for from here. Yeah, from here. Let's put this here. Okay. Let's see. Check. Okay. If there's any problem, sounds or anything, just let me know, put in the chat so that I'm aware. Yeah. So okay, we left the market somewhere around here when we were around here when it was actually going up, right? And I think for those who follow our newsletter, yeah, our newsletter, we issue a newsletter every week, and of course even during our vacation, summer vacations, we continue to actually issue this newsletter. Yeah, this was the issue when I was actually on the break. Yeah, by the seaside. Yeah, by the seaside, enjoyable 10 days break. Yeah. And of course, even during the our break, we did issue some updates on the market so that you guys are not left alone, and we try to actually help you even during our holidays. Yeah. So of course, from the time we have actually left, what we said that there were going to be some volatility within the market, and of course, we did mention that we expect. I think that time there was actually CPI news coming in. We expect the market to actually come down a bit before the CPI, and I think after the CPI, which was basically last week, we also did mention that. Last week was actually a quiet week. No major news. And as a result of that, we actually expect the market to continue to rally. Of course, it did rally all the way from almost the whole of last week, except on Friday. So this was actually the rally which we actually mentioned. Quiet week, no major news. Market expected to rally, and only towards Friday, the market retraced a bit. Basically on profit taking, and also on the back of the bad earnings results coming through from Snap. Yeah, coming through from Snap. I think Snap dropped over 30% last Friday, and of course with that they also brought down Facebook. They also brought down Facebook and other stocks like Google and Apple were also Google, Apple, Amazon. I think most of the major big stocks also retrace from the weeks of rally. Yeah, most of it actually retraced. S&P actually dropped on Friday a bit, and of course the drop continued on, especially for the Nasdaq market yesterday. Continued on for the Nasdaq market yesterday, and in the issue of newsletter yesterday itself, we actually issued this newsletter, and we did mention also from our expectation this week that we expect the market to decline, because on Wednesday, the Fed fund rate meeting is going to be held to decide how much is the Fed going to increase the interest rates for the US, yeah. And of course, because of this itself, we expect, and also because the big rally last week, right? People would tend to actually expect to take profits, and of course, from there, we did mention that probably from Monday and Tuesday itself, right? The market is actually going to come down, and of course, Wednesday, 2 a.m. Asian time is going to be the Fed fund rate meeting. Of course, post that, we wouldn't know whether it would actually go up or go down. But before that, the likelihood is for the market to actually come down because of risk on by the market and also the funds. Let me check the futures. Futures right now is all red. S&P futures is about 10 to 15 points down. Nasdaq is also about 50 over points down. So we expect this to continue up till today. So for those, I think we did mention even last week itself to actually put in hedges, or even short the S&P or short the market right on towards the end of the last week to profit from the expected price action coming through. Okay, this also coincides. This also coincides with the daily stochastics. Yeah, the daily stochastics. Let me show you guys here. Oops. The daily stochastics. If you look at our not this week, the last week's newsletter, we also publish this thing, which is actually talking about stochastic oversold position for the market. Yep. So stochastic is actually an indicator which we use to see whether a stock or the index is overbought or oversold. And of course, the rally last week, it is actually coming to overbought position here. Yeah. Which is above 80. Yeah, so anything above 80, we deem it as overbought. And once it goes above 80, likely the stochastic will come back down. And if you look at the market here, right, on Friday, on Thursday, it is already above 80, and on Friday last week, it came down. Yesterday itself, S&P were relatively unchanged. Yeah, but for the Nasdaq market actually came down more than the S&P. Yeah, so all these positions, if you look at the positions where it actually rallies up, stochastic overbought, rallies up, stochastic overbought, retrace, stochastic overbought, retrace, stochastic overbought, retracing. probably till Tuesday, and on Wednesday itself, depending, it might go shoot up very fast, or it might go down very a lot. So that is actually a major news event, and of course, when the major news event comes in, you need to actually exit your position if you have any positions in profit. Then you need to actually take profit before that event comes in, because we do not know how big that event can actually trigger the movement up or down. So if you're already in profit, that's why we say if you are shorting the market, if you're already in profit, exit today. If the market continues to go down, exit today. Don't be greedy and hope that the market can continue to go down post the Fed announcement. You need to take your profit and go. Yeah. Then we establish your trades after the event. After the event, we establish your trade. Look at the price action where it is. Yeah. So that is basically how you should actually go about doing your trades and managing your profits. Yeah. So this is what we showed. Yeah. So this is overbought position, retrace, overbought position, retrace, overbought position, retrace. Yeah. So this is S&P. Of course, if you look at stocks, maybe you just pick Apple. It's most likely also going through the same kind of positions. Yeah, if you look at here, overbought, retrace, overbought, retrace, overbought, retrace, overbought, retrace. Here is some slight retracement. Here again, overbought, continue to go up. Yeah, so it depends also on sometimes on events like. Yeah, so it is not always, but chances are it is going to high chance that once it's overbought, it retreats. Like for example, this is somewhere in November, right? Okay, November, December, maybe the market is actually still quite bullish, but overall right now in a bear market, we tend to actually see the rallies to be the rallies up, right, tend to be very short, and a lot of profit taking activities, because the bear market of course came in right towards from January on, right? If you look at most of the stocks, right, the bear market actually came in from January onwards. Most of the stocks would actually be on a declining trend. Maybe even if you look maybe what stocks. So even if you look at Amazon, say from January itself, right, you see the trend has actually changed to coming down, and in each of the rally, right, each of the rally up, comes down, rally up, comes down. You see the stochastic. May look at the stochastic, rally up, come down, rally up, come down. Yeah. So when we did our newsletter, the last week, right, not this week one, basically we did what is that, an option structure, what we call credit call spreads. Yeah, which is basically a bear call spread, which takes the direction, a bearish direction for the stocks. And of course, this trade we can actually enter when we look at this kind of positions within the market. Just bear with me a while. I just check any messages. Yeah, no messages. Let me just put this up. Okay, let me just put on my other screen this so that. Okay, so we say that once the position of a stock or even the index, you can also trade the index, is over overbought, right? Then we can actually take on a bear call spread or credit spread. Okay, so what we do for this kind of trade is that we basically sell one out of money call, out of money call, probably around delta 20 to be safe lah. I mean, you can actually do it more aggressive at a higher delta. Of course, when you do it at a higher delta, means that your call strike, which you sell, right, is actually closer to the market price, and if you do a lower delta, which is actually at delta 20, we are actually taking on a higher probability of around 60 to 70 to 80% likelihood that it won't hit your short call strike. Yeah, it won't hit your short call strike. And I mean, there is not any real reason for you to actually take more risk during this volatile time. If you do delta 20 on the call side, it is safe, but still there is risk that it can actually trigger. But of course, you can actually do a smaller take profit on a smaller, based on a smaller percentage, instead of waiting for the full premium to expire worthless. You or 50% on a normal basis, you can just exit when the premium when the premium profit is actually at about 25% level of your max profit. Yeah, so the trade goes selling a short call at delta 20, and buying a higher call, higher out of money call above your short call strike. Of course, you can actually set this with that means the price difference from your short call to the buy call is actually strike width of $3 or $5 or even $10. The wider the width, the higher your risk is. And of course, for me, generally, I would actually work on what is that? A width of about $5, a width of about $5, yeah, $5, which makes basically a risk to return of you risk four for one, yeah, and basically a width of five, you actually expect to actually receive a premium of about $100, and your max loss would be $400. Yeah, so duration would be about 45 days. The IV environment would actually be high. Yeah, implied volatility. If you do not know what is implied volatility, you can actually go back to some of our past traders talk, or even the newsletter, to actually read up on IV. We have some issues or talks just based only talking on IVs. Yeah, so this is the risk reward. They actually at 50%. As I said, if you do not want to wait for too long, and if you actually looking for the so-called short burst of movements downwards on the stock or the index, if you're trading that, then you exit at 25%, and basically per trade you can actually get 25 or 30 US dollar profit just on that so-called quick movement down on overbought positions of the stocks. Yeah, that can come as fast as 1 day, 2 or 3. One day, if it's a big drop, on average, you can actually exit with 25% profit in less than a week. Yeah. So this was the one which we actually covered on the last week's traders last week's newsletter. And of course, this week we also covered another one, another so-called strategy, and of course that one basically is more for people who actually buy shares on the stock market. Those people who actually buy shares on the stock market, right? So for those people who actually buy shares on the stock market, we also have this strategy called covered calls. Okay. So covered calls is basically a situation where you actually hold 100 shares. In order to do a covered call, right, you need to actually hold 100 shares in a stock, 100 shares, yeah. And basically, for example, because nowadays, right, a lot of people are actually buying shares because share price is actually very cheap, right? Because the market is actually coming down, right? And a lot of good companies, you can actually start to actually invest or put in your buy-in positions at a very good price. But the problem is that the market continue to actually come, it goes lower and lower. For example, if you actually are doing Google, right? So, I mean, Google did a share split, and this price is actually a post share split, and a lot of people have actually entered into positions like Google and Amazon. I would think because in the past, in order to actually own Google, right, you need to actually pay how much? 3,000 $2,500 or $2,200 per share, yeah. So in order for you to actually own 100 shares, right, you can't, you need a lot of money, basically, yeah. You need a lot of money. You need 200 over 1,000, 200 over 1,000 to buy 100 shares. But right now, it makes owning this stock more affordable because they just did the one share for 20 split, right? So they actually split their shares to 20, and as a result of that, Google is only about now about $107. Yeah. So a lot of people have actually entered into this taking into the thing that Google, they bought four, so they bought how many shares? They bought 5 shares. They bought 5 shares in Google, and post split, they now own 100 Google shares. But the timing when they buy it, right, it is actually, it can be a situation where they buy it at when it dipped down, say to here, right? Okay, you thought that, oh, Google came down to this level. There's one support, two support, three support. Good buy. They actually bought in at $125 here. Yeah, they bought it at 125 pre-split, yeah. And of course, the price continued to actually go down from here by another close to $18. $18. So it's like, oh, you're losing $18, which is $1,800, right? You're losing $1,800 when the price goes lower. And by just doing nothing, you are just basically going to lose this $1,800. Yeah. So the thing is, we have this thing covered call, right, to actually protect your stock, and also to earn some income, whether the stock goes down or up, right? You can still continue to actually earn premiums. Yeah. So the thing is that when we do a covered call, say for example, you have 100 shares, right? Yeah. And say you actually invested it at, say, what's the price? Say maybe at this level, say at 11111. You actually invested it at 11111 here. Yeah. So what the cover call involves is actually you have 100 shares which you bought, say, at 111. Yeah. You can actually you need to actually sell a call. It can, the expiry date can be 1 week, it can be also 1 month. It does not matter. Of course, the longer duration you sell, the more premiums you actually get. Yeah. So if you actually have a stock you bought at 111, you can actually say you actually want to sell a covered call at, say, 120, for example. 120. Yeah, 120. And of course, when you sell 120, what it means that you will actually get a premium for 120. Yep. It can be, say, 120. Maybe you get if it's a 1 week call, maybe you actually get, say, just for example, maybe you get say $3 lah. Yeah. Say you get actually $3, which is basically $300 per week. Yeah, because the call will actually expire in a week. Yeah, so you sell a call at 120, 1 week duration, you get $300. Yeah, so this $300, you have a stock of 111, you sell it at 120, and of course, let's say you sold it at 120 lah, yeah, so you get this. Of course, the if the price continue to actually go down, right, so your stock price will actually you actually make an unrealized loss, right? Say it goes down to 104, here 104, you will actually get $7 of unrealized loss for your stock, $7 of unrealized loss for your stock. But because the you sold a call at 120, right? This $300 premium which you did, this call will actually expire worthless. This call will actually expire worthless because the strike price is the market price is lower than the strike price on closing. So this $300 you keep, yeah. So this $300 you keep to reduce your unrealized loss of $700. If you did nothing, lah, guys, if you did nothing, what happened is that you have a loss of $700. Yeah. But if you sold a covered call above your investment price, you will actually make this $300. Even though the stock price comes down, you will still continue to make this $300. So that $300 it reduces your loss, and it also at the same time averages your cost of investment. Yeah, cost of investment by $300, because post that, right, after you did that, the stock price moved back to above 111. Say you did it somewhere here, and it expires worthless, and the stock price comes back to 111. So this $7, you no longer have this unrealized loss, but you make this $300 you keep. So instead of having a cost of 111, your cost now becomes minus 3, which is 108. Yeah. So of course, you can actually continue to do it. And what we advise you guys to do is always do it on the rally up, and when the stochastic is overbought. And say at 120 again, when it comes here, you do it again. You can actually sell it at, say, 130, for example. Yeah, 130. As long as it's above the current market price, when you sell it for 130. Maybe another week you make another $300. Then the stock price comes down. Yeah, you make another 300. Stock price comes down. Doesn't matter, because you are keeping Google anyway. The 100 shares, you're keeping it anyway. So the price comes down, and of course here you make another $300 premium, and you have again unrealized position of again here 107, which is another $400 unrealized position. But you have this $300 premium to cover it. It expire worthless again. So this is the second round you do, and now you actually collected 600 of premium, and you reduce your cost base from 111 by $6 right now, and your cost base comes to 105 now. 105 now. Yeah, 105. And then you again, the thing is here, stochastic overbought, again comes back up here. Yeah, your cost is 105. Yeah, comes back here. You sell another one, maybe $300 a week, $300 for the week. It actually then comes down here, maybe expire worthless. Yeah, and then you keep that $300 become $900, and you continue to do this process. And this is actually very good for a stock which you can actually see that it's actually going sideways, going up and down, You can continue to repeat this process every week. If you do a short term which needs more management time, you can actually do it every week. Of course, when the market is very volatile, I personally tend to do it on a shorter time frame. Yeah, because if you do on a longer time frame, things might change by the time it expires, and then basically Google might actually turn from a sideways to actually uptrend. And then what happens in that situation is that you are capping the profit that you can actually make from the stock to the strike price which you have actually sold the call. Yeah, to the strike price, because your so-called risk profile is going to be something like this. Yeah, something like this. You are capping it at the this is actually the strike price of your short call. This is actually you are capping your profit. Yeah, so if Google goes up above your strike price, you are not going to actually enjoy that anymore on your 100 shares. You are capping it already. But even having said that, if you actually do not, if it is actually above the price, and if you actually do not want to, if that means your strike is already in the money, but you do not want to actually close the position, you can continue to actually roll the calls, in the money calls. You can continue to roll the in the money calls for additional premium. Yeah, for additional premium. Yeah, so even though you are capped, you continue to actually roll it. You will probably get $100 additional premium. From the in the money call which you actually roll, but your upside is going to be slower. And of course, there is also risk that you might get assigned this call and your 100 shares is actually taken over. But there's no risk to us because we already cap our profit. Anything above that cap is going to be beneficial for us. It's going to be beneficial for us. It is okay, because when we did that, we already expected that if it goes above our call price, we don't mind giving away the shares. Yeah, but of course, if the share price after rolling in the money for 1 week or 2 weeks, and you gain additional premium, if it comes down below that in the money strike price, then you will again so-called enjoy the so-called full premium, and your call expire out of money again. Yeah, out of money again, and you continue to actually hold this 100 shares. Yeah. So there are many things right here. I hope you guys get the idea of what I'm trying to actually share. So it's important for those guys who do not get into options, right? Don't waste your what is that, your investment, right? Your so-called your capital, right? By not generating any premiums, yeah. because you already have this 100 shares, okay? And if you do a covered call, right, based on the method which I actually shown you just now, right? When the stock price is overbought, and you actually enter into a cover call to protect in case there is actually a retracement, it is additional premium to you. If you do nothing, your cost of investment is going to be like just now all the time 111. That's your cost of investment. But if you continue to actually do this, right, the first round it goes down by say $300, then the second round it goes down by another $300. You continue to actually reduce your cost base for your investment. Yeah, so this is actually one way, by using the same kind of capital which you have, but at the same time continue to actually generate income when the stock price actually retraces and actually comes down. Yeah, so this is another strategy where you complement options to actually make more returns for your capital, or protect your stocks, protect your stock value. Yep. So I mean, for myself, of course, this is when you actually have 100 shares, and of course, for options traders, we can also so-called mirror this kind of strategy. I'm basically doing a so-called synthetic covered call. Even though we do not have this 100 shares, we can also do a synthetic. And of course, that kind of structure would fully involve options. And I think we also covered this strategy in the past. I think last, if not mistaken, last June's Traders Talk, and also the newsletter. We also covered it using a diagonal strategy. Yeah, a diagonal strategy is more or less like a synthetic covered call. where we try to actually do an option structure to try to actually mirror holding 100 shares. We call that also as a poor man's covered call. Yeah, so poor man like me don't have enough money to actually buy 100 shares, right? So we actually structure out a synthetic stock, yeah, using options, and then start to actually generate weekly or monthly income using that so-called poor man's poor man covered call, fully options. Yeah, but of course, if you already have 100 shares, don't waste that 100 shares sitting there, not generating income. Yeah. So look again at your portfolio. Which are the stocks which you have 100 shares, and then start to actually implement this covered call strategy. Okay. The thing is that don't sell a call below your cost. Don't sell. I mean, for example, if you bought the shares at 111, don't sell a covered call at 100, yeah, because when you sell a covered call below your cost, what will actually happen is that you are indirectly so-called realizing that difference of 111 to say 100, that in case when if the so-called stock expires in the money, your shares will actually be sold at say 100. That means you're realizing that yeah, 11 dollars if it expires in the money. Yeah. We try to actually do it above. Of course, if you are more experienced, then you how to say, you can manage this kind of positions, which is doing it below, but we don't advise it. Yeah, we don't advise it. If you are very experienced, then you can structure it out, but you need to actually know what is your risk when you're actually going into this. Yep. So for normal traders or people who are actually starting to use this strategy, my advice is actually always do it above. Always sell the calls above your cost of investment. Yeah. And if you continue to do this, when you see overbought positions, that's the time where you continue to uh, uh, your chances are that you can actually continue to actually sell the calls, and it will actually expire out of money, and you can actually make that premium continuously lah. Continuously, and it's the best market right now. If you see most of the stocks, right, it is actually really going sideways. If you look at many stocks, Google, let's say, even if you look at Microsoft, you can actually see that these stocks right now, it is actually moving sideways. Of course, it can continue to go down. Yeah, continue to go down is the risk to your stock, right? So when it is actually on a downtrend and you do not have intention to actually sell it, you do not have intention to actually sell the stocks. You are just keeping it, or you are doing average cost in, right? Then you it's not a loss for you every time when it actually goes up to overbought or on resistance, right? It's not a loss for you to continue to actually sell calls above these levels. Yeah, goes up, resistance, double top resistance comes down. Yeah, you can actually sell calls safely at these levels. Yeah, so these are the things. But of course, like I said, in the event that major news are coming in, right? So there is actually risk that things might actually change very fast. That the prices can actually rebound and shoot above all these so-called resistance very quickly. So if you're actually doing it, and if you're already in profit, you exit the position, because you don't need to wait until expiry. Yeah, you don't need to wait until expiry. You can actually exit or close the position anytime you like. Yeah. So for example, like I said, the major news on Wednesday 2 a.m. Wednesday 2 a.m. on the Fed fund rate. If you're doing this cover call, which is bearish, right? Which is bearish. then if you're in profit, then you can just close the position, exit it. Let's wait for what happens after that to re-establish your position, because stock price can actually say go up very fast, and then again the stochastic is actually overbought. Then that's the time where you actually take the huge upswing, sell call at the higher price, and then that you actually get the benefit of enjoying the increase in value of your 100 shares. Yeah, plus you actually get potential of earning this premium when there is actually a retracement coming from a sharp increase in price to continuously protect your 100 shares investment. Yeah, so covered calls, very powerful strategy. Yeah, if you are not using it, learn this strategy, deploy it, read our newsletter here. You can actually see I mean, we put in when to deploy, when to exit, and all. You can actually read the newsletter. If you have any problems, come back to us, and we can actually guide you along to see how you can actually work this strategy out. Yeah. So I hope you guys had a good session today, and of course the market right now, yeah, it continues to be around the same level just before we actually started our talk, right? Just before we actually started our talk, it remains bearish at the moment. Yeah, even if you look at Nasdaq, right? Nasdaq, yeah. So for the past Friday and yesterday, right, it is actually coming down, and of course the level which we are looking at, of course, is around this level here, about 12,000. Wait, let me get my pen. Yeah. So Nasdaq, basically we are looking at around 12,000 level, which is coming back to this 50 moving average. Yeah, 50 moving average, and of course if it comes down here to see whether this 50 can actually support the Nasdaq, right? And of course, the expectation for the Fed fund rate hike is actually about 75 basis point. Yeah, 75 basis point. That's the market expectation, and I mean, personally, it's my personal view. I think they would most likely maintain the 75%. Yeah, because earlier they wanted to increase the rate as much as they want. The faster, the higher they want to actually control inflation, right? So inflation last month basically is at 9.1, if not mistaken, 9.1%, and of course that was actually higher than May. Yeah, so the June news is actually higher than May, and of course with that CPI higher, right? I don't think they would actually do anything below 75 to 50, and I don't think they will also do it higher to 100 basis point also. Yeah, because I mean, if you look at the post, that means because these are lagging indicators, CPI is always 1 month lagging. Then if you look at the July numbers, right? Oil price and all is actually coming down, right? Oil price for has actually been coming down. If you look at oil, right, oil has actually been coming down since early of this was actually July, right? So July it has actually been coming down. Yeah. So basically, when this comes down, then the expected inflation reporting for July, which will be reported next month, right, is expected to actually reduce from the 9.1%, because mainly the CPI basket, the causes for this inflation, majority of it is actually coming from the high gas and high energy costs. Yeah, so that's why I would say they probably won't be that aggressive to actually hike it to 100. Of course, if they hike it to 100, then the market is not as expected, then the market will continue to crash. Yeah. Then of course, if you already have a covered call, then you don't have to worry because you will straight away get that premium. And when the the July CPI is announced and it is actually lower, right? Then of course at that time your share price would actually continue to recover. Yeah, and yet you have already earned that so-called premium from the covered call, which was actually protecting your 100 shares. Yeah. So this is basically how I would actually see the market to actually move within this week this week this week. Yeah. So yeah, so that rally, if it hits here, it might actually go back up lah. I mean, go back up if this actually forms a support and there is actually not much different expectation on the Fed on the interest rate hike from the 75 expected basis point increase. Yeah. Okay, so I will see you guys next week. Yeah, so I will see you guys. Next week. And of course, in between, always I need more engagements from you guys. Please put in our Facebook whatever questions you may have, and even if you actually find the show to be informative, which is really help you lah, yeah, which really help you in improving your trading and improving your understanding on how to actually invest, how to actually trade the stock market, how to actually use options. Please put in a review on our Facebook page, share to more of your friends, get more people in here. Yeah. And in fact, if there are more people coming in to our shows, and if you guys need so-called special training on any topics, share investment, technical analysis, whatnot, do put in the request on our Facebook page. And if I get enough requests, I can also do a special event free of charge for you guys, so that we can actually build more engagement in our show and also our newsletter. Yeah. So catch you guys next week. Have a safe trading week, and I wish you a great profitability in the market. And bye bye.